A significant shift in the global financial system, with a focus on the declining dominance of the US dollar and the rising role of gold, particularly driven by the BRICS nations and China. Here's a summary of the key points. First, dollar's vulnerability. The US dollar's status as the world's reserve currency is facing threats from within: exploding national debt, rising interest payments, questioning of sustainability by figures like Elon Musk, and from outside like BRICS nations, actively working to undermine its dominance. Second, BRICS and de-dollarization. The BRICS nations are seeking to move away from US dollar dependence, increase trade in local currencies, and build a global settlement system that bypasses the dollar. This de-dollarization trend has accelerated due to what is perceived as the weaponization of the dollar by the US, notably by kicking Russia out of the SWIFT system. Third, China's gold-linked payment system, called MBridge. After the initial BRICS plan for a gold-backed common currency called the unit was derailed by the Bank for International Settlements called BIS, China has taken a more discreet lead. They are launching a global payment system called Renminbi Cross-Border Settlement System called MBridge. This system connects 11 Asian and 5 Middle Eastern countries, allowing settlements in 7 seconds comparing 5 days for SWIFT with a 98% reduction in fees and crucially without SWIFT interference. Fourth, gold as a trust mechanism. Gold acts as a crucial element of trust within this new system. While not a direct currency backing, it allows for the conversion of yuan into gold at yuan prices off the Shanghai Exchange immediately, eliminating the need to convert to dollars first. Fifth, multi-jurisdictional gold vaults. To facilitate this gold-linked trade, China plans to build a series of multi-jurisdictional vaults, with the first in Hong Kong, followed by Saudi Arabia, and then spreading throughout the Belt and Road regions like Asia, Africa, South America. These vaults aim to distribute gold ownership and increase trust by making it less jurisdictional, addressing concerns about a single entity holding all the metal. Sixth, U.S. response and potential gold integration. The text suggests that the U.S. might eventually be forced to reintroduce gold into its own system, not by backing the dollar directly, but by pegging it to the U.S. Treasury market to lower borrowing costs. This could involve issuing 50-year Treasury bonds redeemable in gold at maturity, making them more attractive even as the dollar inflates. This move could help the U.S. manage its massive national debt and encourage reshoring of manufacturing. Seventh, IMF and gold. The IMF, despite previously stripping gold of its standard of value role, acknowledges gold as the only universally accepted financial asset that is not someone else's liability. BRICS nations are advocating for IMF reforms, possibly to align with their gold-integrated financial systems.